Hey, party people. Welcome to this week's Money News in Human Words. This week, the first piece that caught my eye was on the alcohol-free drinks maker dominating the AFR's Fast 100 list with this post-lockdown push to sobriety and non-alcoholic drinks. I think this Naked Life non-alcoholic spirits has ridden that wave and totally crushed it with 331% growth, increasing their revenue from $357,000 in 1920 to 6.6 mil in 21-22. This company, it was started in 2016 down in Melbourne by a fellow by the name of David Andrew, used to be a strategy consultant, and totally crushing it. Basically, they've got distribution through Woolworths and Coles, and dominating that space. And interesting to see like these companies that personally I've been getting into non-alcoholic beers and stuff, really enjoying that. I see how they're getting so popular. Seems like it wasn't a thing before, but shows the changing environments and the changes that can happen then to investments as well. Definitely an interesting one to watch, an interesting space to watch when we look at, investors trying to make a buck in the weird market that we're in today. Sticking back to more, I suppose, traditional type finance matters, that one of the things that I was looking at last week is that banks have changed their lending policies to help residential property investors to borrow more. Now, obviously, we've seen the property market cop a bit of a battering, interest rates, ratcheting up at the fastest pace since 1994. And along with that interest rate increase, we've seen borrowing capacities really crunch for property lenders. Now, NAB has come out as the first of the big four banks to increase the amount of rent that people can use when it comes to their mortgage serviceability to apply for a bigger loan. Essentially, when the banks look at how much money you can borrow, they look at things like salary, your expenses, what the affordability is. But when you're purchasing an investment property, they look at how much rent they expect you to get. Now, the banks typically don't allow you to use the entire amount of rent that you expect. They will put they sort of shave a bit of a margin on that, and it's generally they'll accept around 80%. But NAB have just increased that to 90%, which is a big boost to residential property investors' borrowing capacity, which certainly could use a bit of help because we've seen people there was one story where the borrowing capacity is reduced from $850,000 to $500,000 through 7 months of these interest rate rises. And with property prices slumping by as much as 25% since rates started rising in May, I suppose the banks are looking to support the property market and investors and taking a more realistic view, particularly because rental vacancy rates are so low. So it's a little bit unfair that the banks are not allowing property investors to use, such a significant chunk of their rent, which is pretty consistent with that. But the mortgage market is hotly contested at the moment. We're seeing companies like ANZ who are offering $4,000 cash back for people to refinance their loan. So these sorts of things are stimulating some borrowing in the market as well. We've seen at the same time, and another thing that's going to property investors' favor is that rents have massively increased in the last little bit, more than 28% in the last 12 months, according to data from SQM Research. Melbourne rents up by 25%. Perth and Adelaide is around 20%. So these things, when you factor in the increase in rental figures, and then the banks allowing you to use more of that rent when it comes to your servicing, means that the numbers are tipping back into investors' favor. Now, obviously, there's a lot of fear in the property market, but the numbers do still add up. I was just doing a piece on the weekend and looking at the fact that the cost of owning a $1 million investment property has increased from about $8,000 prior to these interest rate increases to about $20,000 annually today. So almost 2 Gs a month, not a small amount of money. But when you factor in the growth in the property market, and especially buying property when the prices are depressed, the amount, the long-term average that should make you is around 63,000. So if you're paying $20,000 to be better off by $63,000 a year, you're still over 40 grand better off. So the numbers are still working, but you have to be able to borrow, and these changes are working to property investors' favor in that. But you better get in quick, because my next piece is on the Canadian property strategy, looking at the instos squeezing into the residential property market. Basically, these instos have figured out, looking at the Australian property market experience, that you can invest in an almost, they say, inflation proof. I don't think anything is fully inflation proof, but inflation proof investment approach through property, because of the fact that when inflation is going up and wages are going up, then rents are going up. So it protects you from a lot of that inflation risk that you just don't get in other investments. Now, looking at this piece, looking at the huge student accommodation in Homebush, and showing that there's a level of inflation protection there, which, given the fact that the next 10 years, it's likely to be a little bit more difficult to make money or make the sorts of returns that we're used to in property investing, we're going to see the people that are being smart and really considered with their strategy. Now, build to rent is one of these areas that is high on the list in terms of returns. And for instos entering the market, it's like what's happening overseas. Part of me thinks it's positive that we're seeing instos come into the residential property space. They're making rents more affordable and property more affordable for people. But the other part of me feels like for Aussies might end up getting priced out of the property market with all of the insto players coming in, because they can see all the opportunity. They're buying up big chunks of the property market, and it's making it harder for people to get in. So this says to me that if you're not yet in the property market and that's on the roadmap for you, which it probably should be, should focus hard on finding that entry point and making your way in before you end up getting priced out of the market. My last piece for this week was on the top stocks for an unsettled 2023 have been named. Basically, we've seen the ASX 200, so the 200 largest companies in Australia, surging this month. They're up more than 12% since the start of October, and now sitting just 2.6% below the start of year price in the market. So there is some turbulent times forecast ahead, and I think the experts are saying that investors should be making sure that their portfolios are nicely diversified with a good balance of different companies in different sectors, as well as defensive stocks and cash holdings, so that, you know, if we do experience particularly some of the worst case scenarios that are being forecast, that there's a level of protection there. Now, Morningstar have just come out and they released a whole bunch of research. They're a massive investment analysis firm, that they think that growth stocks are going to come under more pressure next year. And they feel that companies that are offering sustainable income levels and decent dividend payments, like healthcare and consumer staples, because they're saying that they feel that with the market being flat or rocky, that a big chunk of investor returns over the next 12 months are going to come from income, and only around 20% of investor returns will come from capital. So their top picks were Santos, Whitehaven Coal, AGL Energy, and Aurizon. Now, you see that these companies are in that resources space, which has been massively out of favor in the last little bit. Goes to show to me that there's still value out there, but choosing good investments are all important. And it's funny that, you know, if they would have done their picks last year, it was all tech heavy investments, which have really copped it in the last 12 months, which tells me that even the experts probably don't really know. And it highlights the fact that it's so important that when you're choosing investments, even when you find something that's going really, really well, you tread carefully and make sure that you're balancing out your risks, so that when the market conditions turn, you don't end up getting caught holding the bag and you're suffering from a return perspective as a result. There's a lot of investors in that space. So over the last couple of years, we saw a ton of people looking at the fact that tech had just risen and risen and risen, and they thought that it would just keep continuing forever. Those people have copped it a little bit, and there's a lesson in that for this year. Even if that resources are doing good, doesn't mean that they'll continue to do good forever. Guys, that's it for me for this week. I